So this video is going to take a moment and just walk through some of the compliance issues for loan processing for your owner finance transaction. If you find this helpful, take a minute and like the video. Don't forget to subscribe to our YouTube channel as well. And don't forget to comment below. We'd love to answer your questions. So a lot of people ask, why do I need to process my buyer? Well, the first answer is it's going to depend on what state you're in. Now, if you're in Texas, there is an initial 3 property de minimis rule, meaning if you do fewer than 3 transactions in 12 months, technically speaking, you don't have to process the buyer. But just because you don't technically have to process, it doesn't mean that you shouldn't process the buyer. Now, the real key though is in all other states, as far as I know, there's this thing called the SAFE Act, which is a federal act that covers all states. And on your very first transaction, very first owner finance creative transaction, you must provide the buyer certain information. So why am I using a loan processor? Well, most investors don't have the ability to provide the RESPA disclosures. And these are 36 disclosures required under HUD, under the RESPA Act that's out there. And so using the RMLO to process your buyer helps provide those things so that you stay compliant with the SAFE Act. And remember, in all states but for Texas, that's on the first deal you do. And so either you need the ability to provide those RESPA disclosures, or you need to utilize a loan processor underwriter for that purpose in some format. Now, in the Texas marketplace, as I said earlier, there is this 3 property de minimis rule, but we still suggest strongly that you follow the rules every single time, just not after 3. So the first reason to utilize the loan processor underwriter for compiling a processing package is to make sure you're compliant with the SAFE Act. The second thing you want to know to do is you want to be able to look at the 1003 application. That's a standard Fannie Mae application that is used by every mortgage company in the country that allows you as the investor to look quickly at what your borrower has, where they live, how long they've been there, where they work, how long they've been working, what their income is, what the rental amounts is, to help you make more of an informed decision. Now, they may also help you pull a credit report, which you may or may not look at. Typically, when I'm looking at a credit report, I'm looking for negative issues, not necessarily positive issues. And so long as there aren't any negative issues on the report, I don't care about credit, because all that tells me is the ability for the borrower to refinance the transaction. Now, in addition, when you're utilizing a loan processor and getting that processing package, you're going to get enough information to help you make an informed decision, because now you've got to think about the Dodd-Frank Act and what it says. And in the creative finance world, in regards to a consumer, it's basically setting us up on 3 levels: a QM, which is your base level transaction; a high priced loan, which is most of the time where we investors live; and the high cost loan, where we really don't want to be unless we have to for some reason. So when we get our processing package, the first few pages gives us really all we need to know, from information on the borrower, income, etc., debt to income, and oftentimes it will tell us pass or fail as well. And of course, what it's looking at is under a QM status and things of that nature out there. So you've got to have at least a working knowledge of Dodd-Frank, what QM status is versus other statuses, to make sure you understand what you're looking at. And guys, please understand, your loan processor is not the decision maker. You, the investor, the seller, are the sole decision maker in these deals. All the loan processor does is provide you an information package to allow you to make the best informed decision available to you. And so when you do get this package, things that you should be thinking about is, am I required to provide my borrower this information on every deal? Answer is yes, as per the SAFE Act. What does Dodd-Frank say I have to do? Well, I must consider and verify information provided to me by my borrower. I need to be looking at their debt to income ratio, and I need to use a reasonableness factor on their ability to repay the loan. Now, with Dodd-Frank, it appears to stipulate that you're not under Dodd-Frank unless you do more than 5 transactions in a 12-month period. Now, even though that might be the case, of course, we still recommend every single time that you utilize the RMLO and comply with their rules and regulations. It's just a way to keep your nose clean and not run into any issues downstream. I want to be able to look through this package, look at the application, know who my borrower is, so that at the end of the day, I'm able to make the best decision to put my buyer in the property. And so long as I'm reasonable and I'm not really pushing the envelope out there just to capture a down payment only, then the great odds are you're going to be in good shape. So guys, I hope you found this video helpful. If you liked it, take a minute and like it. Don't forget to subscribe to our YouTube channel, comment below as well, and we'll see you guys next time.